Question 1. A Missouri-based captive insurance company is looking to set up a reinsurance treaty with an external reinsurer. Which of the following best describes the most critical factor in structuring a reinsurance agreement for this captive? A. Ensuring the reinsurance treaty complies with federal tax laws. B. Aligning the reinsurance agreement with the captive's risk management strategy. C. Minimizing the cost of reinsurance premiums. D. Guaranteeing the reinsurance agreement covers all risks without any exclusions. Answer: B. Aligning the reinsurance agreement with the captive's risk management strategy. Explanation: in structuring reinsurance agreements, the most critical factor is ensuring that the agreement aligns with the captive's risk management strategy. This ensures that the reinsurance properly mitigates the specific risks the captive is exposed to. Although compliance with tax laws, minimizing costs, and covering all risks are important, they are secondary to ensuring the reinsurance structure supports the captive's overall risk retention and transfer strategy. Missouri law requires that captives maintain appropriate solvency levels and utilize reinsurance strategically to protect their financial health and meet regulatory requirements. Reinsurance should be tailored to the risk profile of the captive, considering the types of insurance written, underwriting exposures, and claims frequency and severity. Question 2. Mr. Williams, the risk manager for a Missouri-based company, is evaluating whether to retain risk or transfer it via a captive insurance company. Which of the following best defines the role of a captive insurance company in this context? A. A captive insurance company is solely used to handle reinsurance for other insurers. B. A captive insurance company provides an alternative to traditional insurance by assuming risks from its parent company. C. A captive insurance company is used exclusively to insure employee-related risks such as workers' compensation. D. A captive insurance company only accepts reinsurance from third-party insurers to diversify its portfolio. Answer: B. A captive insurance company provides an alternative to traditional insurance by assuming risks from its parent company. Explanation: captive insurance companies are primarily designed to provide an alternative to traditional insurance by allowing the parent company to assume and manage its own risks. This helps to reduce reliance on the commercial insurance market, gain more control over coverage, and potentially lower costs. Captives are used to insure a wide range of risks, including property liability and workers' compensation, among others, depending on the needs of the parent company. Missouri regulations allow captives to write various types of insurance, not just workers' compensation or reinsurance, making the structure versatile for managing a broad spectrum of business risks. Question 3. Mr. Anderson is the CFO of a Missouri corporation that has established a captive insurance company to manage its risk. The corporation has sustained multiple minor claims that have resulted in small but frequent payouts. Mr. Anderson is considering adjusting the retention level for his captive's risk management strategy. Which of the following options best describes the appropriate course of action? A. Increase the retention level to minimize upfront costs, as frequent claims can be more cost-effective in the long term. B. Decrease the retention level to transfer more risk to the captive and ensure fewer payouts. C. Increase the retention level to transfer more risk to the parent company and reduce the total number of claims. D. Decrease the retention level to better manage cash flow and limit the financial impact of frequent claims. Answer: D. Decrease the retention level to better manage cash flow and limit the financial impact of frequent claims. Explanation: in the context of a captive insurance company, adjusting the retention level directly impacts the financial management of claims. If frequent minor claims are resulting in financial strain, decreasing the retention level can help manage cash flow by transferring more risk to the insurance market and reducing the captive's exposure. This action can be particularly beneficial for managing the volatility that comes with frequent but low-cost claims. Missouri regulations require captives to maintain sufficient capital to cover both expected and unexpected claims, and adjusting the retention level can ensure the company stays within regulatory solvency requirements while maintaining operational efficiency. Question 4. A Missouri-based captive insurance company is required to submit annual financial reports to the Missouri Department of Insurance. Which of the following is not typically required in these reports? A. The captive's audited financial statements. B. A detailed actuarial report on the captive's reserves. C. The history of the parent company's operations. D. A statement of the captive's compliance with Missouri regulations. Answer: C. The history of the parent company's operations. Explanation: while Missouri law requires captives to submit detailed annual reports, the history of the parent company's operations is generally not a requirement. What is required includes the audited financial statements of the captive, an actuarial report on reserves, and a statement regarding the captive's compliance with relevant Missouri insurance regulations. The purpose of these reports is to ensure that the captive remains financially sound, solvent, and compliant with regulatory requirements. Detailed financial and actuarial data helps regulators assess the captive's ability to meet claims obligations. Question 5. A Missouri captive insurance company is considering a merger with another captive. What is a key consideration for regulatory approval under Missouri law? A. The parent companies of both captives must have similar financial standings. B. The merger must not result in the captive violating Missouri's solvency requirements. C. The merger must increase the total premium volume written by the captives. D. The captive's investment strategy must align with both companies' parent businesses. Answer. B. The merger must not result in the captive violating Missouri solvency requirements. Explanation. Under Missouri law, the most critical consideration in a merger of captive insurance companies is ensuring that the merger does not violate the state solvency requirements. Captives must maintain certain capital and surplus levels to ensure they can meet their financial obligations, particularly when underwriting and managing risks. The Missouri Department of Insurance will evaluate whether the merger will undermine the solvency of either captive, as this could impact their ability to pay claims and maintain regulatory compliance. Question 6. Mr. Thompson's company is considering establishing a captive insurance company. He asks if a Missouri captive can provide health insurance coverage. Which of the following is true? A. Captives in Missouri are prohibited from writing health insurance. B. Captives in Missouri can provide health insurance as long as it is only for the employees of the parent company. C. Captives in Missouri can provide health insurance for any group regardless of employer affiliation. D. Captives can only provide workers' compensation and property insurance. Answer. B. Captives in Missouri can provide health insurance as long as it is only for the employees of the parent company. Explanation. Missouri law permits captives to provide various types of insurance, including health insurance, but only for the employees of the parent company. This is a common use of captives to manage the cost of employee benefits, including health plans. Captives cannot provide health insurance coverage to groups outside of the parent company, as this would fall outside the allowed scope of operations for most captives. Regulatory oversight ensures that captives remain compliant with state and federal health insurance regulations. Question 7. Which of the following is a primary benefit of using a captive insurance company for a business with high frequency, low severity risks? A. It provides access to cheaper reinsurance. B. It offers more consistent and predictable pricing for long-term coverage. C. It reduces administrative costs by avoiding traditional insurance brokers. D. It allows businesses to transfer all risks to an external insurer. Answer. B. It offers more consistent and predictable pricing for long-term coverage. Explanation. For businesses facing high-frequency, low-severity risks, a captive insurance company allows for more consistent and predictable pricing over the long term. This helps the business stabilize its insurance costs, avoiding the fluctuations typically seen in the commercial insurance market. Captives are particularly useful for risks that are frequent but not costly on an individual claim basis, as they allow for better risk management and more tailored solutions. While captives can also help with reinsurance access, administrative costs, and risk retention, the primary benefit in this case is the predictability of costs. Question 8. Under Missouri regulations, which of the following would be considered a violation of the state's financial reporting requirements for captive insurance companies? A. Failing to submit a report on the actuarial review of the captive's reserves. B. Filing a report that does not include a statement of compliance with Missouri law. C. Submitting audited financial statements after the deadline set by the Missouri Department of Insurance. D. Submitting unaudited interim financial statements instead of audited financial reports. Answer. C. Submitting audited financial statements after the deadline set by the Missouri Department of Insurance. Explanation. Missouri regulations require that captives submit their audited financial statements within a set deadline to ensure that the Department of Insurance can review their financial health. Late submission of these documents can be considered a violation, as it impedes regulatory oversight and delays the assessment of the captive's solvency. The submission of interim unaudited financial statements may be allowed under certain conditions, but failure to meet filing deadlines for audited reports is a clear violation. Question 9. Mr. Lewis, the risk manager for a Missouri corporation, is evaluating the costs associated with the formation of a captive insurance company. Which of the following is typically the largest upfront cost in establishing a captive? A. Regulatory application fees. B. Reinsurance premiums. C. Formation and legal costs. D. Operational management fees. Answer: C. Formation and legal costs. Explanation: the largest upfront costs associated with forming a captive insurance company are typically the formation and legal costs. These include the costs of hiring attorneys to draft legal documents, file applications with the state, and ensure compliance with Missouri's regulatory framework. These costs are substantial because forming a captive involves extensive legal work, including creating the company's structure, governance, and business plans. Although other costs like operational management fees and reinsurance premiums are significant, formation and legal costs are typically the most substantial at the outset. Question 10. Missouri captives must meet certain capital and surplus requirements to ensure they can handle potential claims. What is the primary purpose of these requirements? A. To ensure that captives do not transfer too much risk to the external reinsurance market. B. To guarantee that captives can pay claims and remain solvent even in adverse conditions. C. To minimize the amount of capital needed to start a captive and make it easier for businesses to form one. D. To ensure that captives are profitable and able to generate surplus for reinvestment. Answer: B. To guarantee that captives can pay claims and remain solvent even in adverse conditions. Explanation: the primary purpose of capital and surplus requirements for Missouri captives is to ensure that the company remains solvent and able to pay claims even during adverse conditions. This is a critical part of regulatory oversight, as captives must maintain sufficient reserves to meet their obligations under both normal and stress conditions. These requirements are designed to protect both the captives' policyholders and the broader insurance market from financial instability. Question 11. Which of the following would not be considered a permissible risk management strategy for a Missouri captive insurance company? A. Writing insurance for risks not directly related to the parent company's business operations. B. Using excessive loss reinsurance to limit exposure to catastrophic losses. C. Retaining risks that are expected to have a low frequency and severity of claims. D. Using a fronting arrangement to issue insurance policies while transferring risk to a reinsurance company. Answer: A. Writing insurance for risks not directly related to the parent company's business operations. Explanation: Missouri regulations typically require that a captive insurance company write insurance policies that are directly related to the parent company's business operations. Writing insurance for unrelated risks would be outside the intended scope of the captive's operations and could raise regulatory concerns regarding the captive's solvency and purpose. The other strategies, such as using excessive loss reinsurance, retaining low-frequency risks, and utilizing fronting arrangements, are common and permissible practices under Missouri's regulatory framework. Question 12. Mr. Harris, a Missouri business owner, is considering the tax implications of setting up a captive insurance company. Which of the following is a tax benefit that captives may provide under Missouri law? A. Premiums paid to a captive insurance company are always deductible as business expenses for the parent company. B. The captive may qualify for federal tax incentives under IRC Section 831B, allowing it to be taxed as a small insurance company. C. The captive is exempt from state taxes on investment income earned by the parent company. D. Captives are exempt from all federal income tax for the first 5 years of operation. Answer: B. The captive may qualify for federal tax incentives under IRC Section 831B, allowing it to be taxed as a small insurance company. Explanation: under IRC Section 831B, captive insurance companies may qualify for federal tax incentives, allowing them to be taxed as small insurance companies. This can provide significant tax advantages, such as exempting income from the captive's underwriting activities from federal income tax, provided that the premiums written by the captive are below certain thresholds. However, the tax treatment can vary depending on the specific operations. In compliance with IRS regulations, Missouri captives must still adhere to state-specific tax requirements and file appropriate tax returns. Question 13. A Missouri captive insurance company is deciding how to manage its investment portfolio. Which of the following is a general restriction on captive investments under Missouri law? A. Captives are only allowed to invest in U.S. Treasury bonds. B. Captives must invest at least 50% of their assets in real estate. C. Captives must follow prudent investment guidelines and avoid excessive risk. D. Captives are prohibited from investing in foreign assets. Answer C. Captives must follow prudent investment guidelines and avoid excessive risk. Explanation: Missouri law, like many other states, requires captives to follow prudent investment guidelines. This means that captives must invest in assets that are appropriate for their risk profile, ensuring that they can meet their obligations while maintaining solvency. Captives can invest in a variety of assets, including foreign investments, but they must ensure that their investment strategies are conservative and manageable, avoiding excessive risk that could jeopardize their financial stability. Question 14. Which of the following best describes the fronting arrangement in a Missouri captive insurance company? A. A fronting arrangement involves a third-party insurer issuing policies and then reinsuring the risks with the captive. B. A fronting arrangement allows a captive to avoid paying premiums to external reinsurers. C. A fronting arrangement is a regulatory requirement for all Missouri captives. D. A fronting arrangement refers to the captive directly handling all claims and underwriting. Answer A. A fronting arrangement involves a third-party insurer issuing policies and then reinsuring the risks with the captive. Explanation: a fronting arrangement is a practice where a third-party insurer issues insurance policies on behalf of the captive and the captive reinsures the risks with the third-party insurer. This allows the captive to provide coverage while meeting regulatory requirements, particularly when the captive does not have the full licensing or approval to issue policies directly. It is a common practice for captives to use fronting arrangements to gain access to broader markets or to meet regulatory requirements. Question 15. A Missouri-based captive insurance company wants to reinsure risks from another captive. What must the Missouri captive insure in this situation? A. The other captive must be located within the United States. B. The reinsurance transaction must comply with Missouri's insurance laws and regulations. C. The reinsurance arrangement must be approved by the Missouri Department of Economic Development. D. The Missouri captive must receive a guaranteed profit from the transaction. Answer B. The reinsurance transaction must comply with Missouri's insurance laws and regulations. Explanation: when one captive reinsures the risks of another, the reinsurance transaction must comply with Missouri's insurance laws and regulations. This ensures that the captive is maintaining solvency and fulfilling its regulatory obligations. The reinsurance agreement should be structured to avoid excessive risk, and it must be properly documented and reported to the Missouri Department of Insurance. The location of the other captive or guaranteed profits are not typical requirements under Missouri law, but regulatory compliances. Question 16. A Missouri captive insurance company has written excessive loss coverage for its parent company. What does excessive loss coverage provide? A. Coverage for all claims exceeding a specified amount without a limit on the total payout. B. Coverage for losses that exceed a certain threshold but only up to a specified maximum amount. C. Full coverage for losses that occur above a minimum threshold. D. Coverage for the first dollar of a loss up to the retention limit. Answer B. Coverage for losses that exceed a certain threshold but only up to a specified maximum amount. Explanation: excessive loss coverage is a type of reinsurance where the captive covers losses that exceed a certain threshold, known as the retention limit. This coverage helps the parent company manage large unexpected losses by transferring the risk for losses above a specific dollar amount to the captive. While the coverage does not cover all losses, it protects against catastrophic or unusually large claims with a specified maximum payout. Question 17. A Missouri captive insurance company is considering changing its ownership structure. Which of the following is a requirement under Missouri law for a change in ownership? A. The captive must obtain approval from its policyholders before changing ownership. B. The Missouri Department of Insurance must be notified of the ownership change. C. Ownership changes are prohibited unless the captive's assets are sold to an outside party. D. The change in ownership must result in the reduction of the captive's capital reserves. Answer B. The Missouri Department of Insurance must be notified of the ownership change. Explanation: under Missouri law, any change in ownership of a captive insurance company must be reported to the Missouri Department of Insurance. This allows regulators to ensure that the new ownership structure complies with state laws and that the captive remains solvent and able to meet its obligations. Captives may change ownership, but they must notify the department and ensure compliance with all relevant regulations. Question 18. Which of the following is a common use of a Missouri captive insurance company? A. To write insurance policies for unrelated third parties. B. To assume the liability for risks that are too large for traditional insurers. C. To manage risks that are related to the parent company's business activities. D. To provide life insurance products to the general public. Answer: C. To manage risks that are related to the parent company's business activities. Explanation: Captive insurance companies are typically formed by businesses to manage risks that are related to the parent company's specific business activities. These risks may include property damage, workers' compensation, liability, and employee benefits. The captive allows the parent company to retain and manage these risks internally, often resulting in cost savings and better control over the insurance process. Captives are not generally used to write policies for third parties or provide life insurance to the public. Question 19. What is one of the key advantages for a business in Missouri to create a captive insurance company rather than purchasing insurance from a traditional carrier? A. Captives always have low premiums than traditional insurance carriers. B. The captive can tailor insurance coverage to the specific risks of the parent company. C. Captives can avoid paying state insurance taxes. D. Captives allow businesses to transfer all risks to external reinsurers. Answer: B. The captive can tailor insurance coverage to the specific risks of the parent company. Explanation: One of the main advantages of forming a captive insurance company is the ability to tailor coverage to meet the specific risks of the parent company. Captives allow businesses to design policies that are more aligned with their unique needs, which can result in better risk management and more cost-effective coverage. While captives can sometimes lead to low premiums, the primary benefit is customization. Additionally, captives do not eliminate state insurance taxes, and they do not typically transfer all risks to external reinsurers. Question 20. Under Missouri law, which of the following entities is not eligible to form a captive insurance company? A. A corporation that owns other businesses and needs to insure their risks. B. A single business entity with a unique risk profile requiring customized insurance coverage. C. A group of unrelated businesses that want to pool their risks together. D. A government entity seeking to insure public sector employees against workplace injuries. Answer: D. A government entity seeking to insure public sector employees against workplace injuries. Explanation: Under Missouri law, government entities are generally not eligible to form captive insurance companies. Captives are typically formed by private businesses or groups of businesses to manage specific risks. While government entities may have their own risk management strategies, they are usually not permitted to form captives for insuring public sector employees against risks like workplace injuries. The other entities, such as corporations and business groups, are allowed to form captives for insuring business-related risks. Question 21. Which of the following is required for a Missouri captive insurance company to maintain its license? A. It must have a minimum amount of capital and surpluses required by Missouri law. B. It must write insurance policies for unrelated third parties every year. C. It must pay annual premiums to a reinsurance company. D. It must obtain approval from the Department of Insurance for every policy issued. Correct answer: A. It must have a minimum amount of capital and surpluses required by Missouri law. Explanation: To maintain its license, a Missouri captive insurance company must meet the capital and surplus requirements set by the Missouri Department of Insurance. This ensures that the captive is financially solvent and able to meet its obligations to policyholders. Writing policies for third parties or paying premiums to reinsurers is not a licensing requirement for captives. Question 22. What is the primary reason businesses in Missouri form captive insurance companies? A. To reduce the costs of general liability insurance. B. To gain control over their risk management and financing. C. To sell insurance policies to unrelated entities. D. To avoid state insurance regulations completely. Answer: B. To gain control over their risk management and financing. Explanation: The primary reason businesses form captive insurance companies is to gain more control over their risk management and financing. Captives allow businesses to retain and manage their own risks, potentially saving costs on premiums and offering more flexibility in coverage. While captives may reduce insurance costs, their main advantage is internal risk management rather than selling insurance to third parties or avoiding state regulations. Question 23. A Missouri captive insurance company is considering forming a risk retention RRG. What is one of the main characteristics of an RRG? A. It is limited to offering coverage only for workers' compensation risks. B. It is A group self-insurance pool formed by businesses with similar risks. C. It requires a third-party insurer to issue the policies on behalf of the group. D. It can only insure the risks of the group's owners and affiliates. Answer B. It is a group self-insurance pool formed by businesses with similar risks. Explanation. A risk retention group, or RG, is a group self-insurance pool that is formed by businesses with similar risks to collectively manage and insure those risks. RGS are typically used by businesses in the same industry or with similar operations that want to share risk in a cost-effective way. They are not limited to workers' compensation coverage, and they typically do not require a third-party insurer for issuing policies. Question 24. Which of the following is a requirement for a Missouri captive insurance company regarding its financial reporting? A. It must file an independent audit report with the Missouri Department of Insurance annually. B. It must submit quarterly reports on its policies to the Missouri Department of Economic Development. C. It must provide a report of claims history to its policyholders each year. D. It must disclose all premium rates to the public and Answer A. It must file an independent audit report with the Missouri Department of Insurance annually. Explanation. Missouri law requires captive insurance companies to file an independent audit report annually with the Missouri Department of Insurance. This audit ensures that the captive is in compliance with financial regulations, maintains adequate solvency, and is managing its assets and liabilities appropriately. Captives are not required to file quarterly reports or disclose premium rates to the public. Question 25. Which of the following describes a pure captive insurance company under Missouri law? A. A captive that insures the risks of its parent company and affiliates only. B. A captive that insures unrelated third parties to diversify risk. C. A captive that offers general liability coverage to all Missouri businesses. D. A captive that operates as a risk retention group for multiple businesses. Answer A. A captive that insures the risks of its parent company and affiliates only. Explanation. A pure captive insurance company is one that insures only the risks of its parent company and its affiliates. This type of captive is used for self-insurance and managing risks within the organization. Unlike a group captive or a risk retention group, a pure captive does not insure third parties. Question 26. What is the role of the actuary for a Missouri captive insurance company? A. To develop marketing strategies for the captive's insurance products. B. To ensure the captive complies with all state insurance laws and regulations. C. To calculate the appropriate premiums and evaluate the captive's solvency. D. To sell policies on behalf of the captive to other businesses. Answer. C. To calculate the appropriate premiums and evaluate the captive's solvency. Explanation. The role of the actuary in a Missouri captive insurance company is to calculate the appropriate premiums based on risk assessments and to evaluate the financial solvency of the captive. Actuaries help ensure that the captive's reserves are adequate to cover potential claims and that premiums are set at levels that reflect the actual risks being insured. Question 27. A Missouri captive insurance company is considering using a third-party administrator, TPA. What is one benefit of using the TPA? A. It allows the captive to avoid paying taxes on premiums. B. It provides administrative support for claims processing and policyholder services. C. It gives the captive the ability to reinsure all of its risks externally. D. It allows the captive to avoid any state insurance regulatory oversight. Answer. B. It provides administrative support for claims processing and policyholder services. Explanation. A third-party administrator, TPA, provides administrative services to the captive, including claims processing, policyholder services, and other operational tasks. Using a TPA can help the captive streamline its operations, manage claims efficiently, and reduce the administrative burden on the captive's staff. It does not allow the captive to avoid taxes or regulatory oversight. Question 28. Which of the following is a common reason a Missouri business might decide to rent a captive insurance company? A. To avoid the regulatory requirements of forming its own captive. B. To transfer all risk management responsibilities to an external insurer. C. To access the benefits of a captive without forming its own. D. To reduce its regulatory reporting obligations entirely. Answer. C. To access the benefits of a captive without forming its own. Explanation. Renting a captive refers to a business using an existing captive insurance company, usually a group captive, to access the benefits of captive insurance without forming its own. This allows businesses to enjoy customized insurance coverage, potential cost savings, and risk management benefits without the administrative complexity and capital requirements of establishing a separate captive. Question 29. In Missouri, a captive insurance company may only provide insurance to A. the parent company and its affiliates or other companies in the same industry, B. the general public, including individuals and other businesses, C. insurance companies and reinsurers only, D. entities that are not related to the parent company. Answer A. The parent company and its affiliates or other companies in the same industry. Explanation. In Missouri, a captive insurance company is generally limited to insuring the risks of its parent company and its affiliates. In some cases, it can also provide insurance to businesses that are part of a common industry, such as in the case of a group captive. However, captives do not typically write policies for the general public or unrelated businesses. Question 30. What is a protected cell in the context of a Missouri captive insurance company? A. A separate legal entity that provides insurance to third-party entities. B. A segregated account within a captive that allows for different risk management for each cell. C. A type of reinsurance arrangement where the captive assumes all risks. D. A financial reserve set aside to cover claims in the event of insolvency. Answer. B. A segregated account within a captive that allows for different risk management for each cell. Explanation. A protected cell refers to a segregated account within a captive insurance company where assets and liabilities are kept separate for each individual cell or business. This structure allows multiple businesses to participate in a single captive while keeping their risks and finances distinct, providing a flexible and cost-effective insurance solution for different entities. Protected cells can be used to manage risks for various policyholders within the same captive.